This is Mid-Atlantic Women in Agriculture's Wednesday webinar, Grain Marketing 101. Our presenter today is Shannon Dill, Extension Educator for University of Maryland. All materials mentioned during the webinar can be found on our website, and a special thank you to our sponsor, Farm Credit. Thank you for listening.
Well, so today we're going to talk about, again, the terminology. We're also going to talk about where you can get grain marketing information from, and then making some trading decisions and how to put together that marketing plan and make decisions. And everybody likes the Keep Calm logo, so we made one that's keep calm and trade grain. So not always an easy thing to do. So we're going to talk a little bit about some terms that are used in marketing. Futures is a term that most people hear. This is the national price set for grain. So nationally, there's one price for corn, there's one price for soybeans, and there's one price for your different varieties or types of wheat. That's the national price that's set. It's the price that's quoted nationally for that grain. And most of the time, the futures contracts, when we put those contracts in, they might not necessarily result in physical delivery. And if you do decide to do a contract, it's done through a broker in 5,000 bushel increments, and often will require a fee. So we'll talk a little bit about contracts in a little bit, but the futures, again, is that price that's being quoted nationally in the Chicago Board of Trade, which is now the CME Group. You go there, that's the price that's being offered. Then there's the cash price. And so locally, one area may quote a cash price differently. So it's the local price quoted for grain by individual buyers. So I'm in Easton today, and I may call our Easton Purdue plant, and they say this is what we're selling for corn and soybeans. I may call the lower shore to a Mount Air elevator, and they quote me with a different price. So the cash price is what's locally being offered. When you do a cash price contract, it requires delivery, and you don't need a broker. There's no fee or bushel limits. So the cash price is the local price that's being offered for your grain. And it depends on when you're looking at cash price for delivery. So right now, maybe I have grain in storage, okay? Of course, it's out of the field by January, let's hope. And it's in storage right now. So maybe I want to know what today's cash price is. Or maybe I want to know what harvest cash price is when I would be physically delivering that grain. So we're talking about futures price and then cash price. Then there's the term basis. And what that is the difference between the cash price and the futures price of a particular commodity. All right, it's calculated as the futures price minus cash price, or you take that difference, is the basis. And the basis can be positive or negative. So right now, if the futures price, so the national price, is $4, and I call my local elevator and it's $3.50, it's a negative basis. So it's 50 cents below the national price. So that 50 cents is the basis, the $4 is the futures, and the cash price is $3.50. We are lucky here on the Mid-Atlantic, and depending on where you're at, whether you've got the end user for that grain, you can have a very strong basis. And so we talk about here having a strong basis because of the poultry industry. We need the grain, so elevators may price grain higher than the national price, or maybe it's even with the national price. It may be places that have an excess, so years where there's a surplus of grain, possibly there would be a negative basis. So basis, again, is that difference between the national price and what you can sell locally your grain for. And a lot of people will track the basis. They'll look they'll call multiple elevators, or they have a relationship with more than one place that they sell their grain to find out what the basis is. And again, it varies by the demand for the grain that you have. So a bumper crop or a large crop may have a smaller basis, whereas a higher crop, maybe not as productive of a season, they're going to want, your local elevator is going to want that grain. So that's what the basis is. So as a grower, or even not as a grower, and you would be surprised at how many people who are not farmers, are not in the agricultural industry, many of these people they do trade grain. They're the speculators. They're the ones, they don't physically deliver it, but they can purchase contracts. So I'm going to talk about grain marketers, and then I'm going to talk also about farmers. So we talked some about the futures contract, and that's a contract that's traded on the futures exchange, and it's for the delivery of a specific commodity, and most of the time you won't physically deliver it. You won't take your grain to the futures exchange at Chicago, but you're going to offset that transaction. To be into a futures contract, generally you have to have a broker, and there are margin calls, or there's fees that are associated with that transaction. So being in the futures market, you do need to have, often they'll have an account set aside, and that will help with the expense of trading and buying and selling grain on the futures market. The forward contract is what we talk about most often with farmers, and then your local grain dealer. So if I call the grain dealer and I like the price at harvest today, I can make a forward contract, and I can go into an agreement and say, I'd like to forward contract my grain. I want to sell this many bushels to you for this amount. And generally, grain is traded in those 5,000 bushel increments. So I'd like to sell 10,000 bushels of grain at your harvest price. I like the price today. It covers my expenses for grain, so I'm going to enter into a forward contract. You can't sell that contract. There are some negotiating you can do. We've had some issues with drought years. You can work with your elevator, but you are required to deliver that when you're in a forward contract. And that's the price of delivery, so there's no basis included. The price is the price. A hedge to arrive, it's not as popular here, but very popular in the Midwest. And that is for the cash sale of grain, just for the price that day, not for the basis. And so if you're not happy with the basis contract, maybe you just lock in the price and you wait on the basis. You can also do a basis contract, so that's the reverse. You don't price your grain per bushel, but you do lock in a price for that basis amount, so that difference. And you can do that, again, individually with the grain. So farmers would use the forward contract, a hedge to arrive, or a basis contract. Those are the three that, that farmers and producers would use. And then I don't get a lot into options today. They're definitely not a grain marketing 101 topic, other than just talking about that they are a strategy. These also require a broker, and they don't require delivery. You actually, what you're doing is you're setting a price floor or upside potential on that grain. So it's a contract that you go into, you pay a fee for it, you pay a broker fee for it, and the idea is that when you exit that contract, so when you sell it, you get hopefully a price difference. So if I buy a call because I think prices are going to go up, I could sell it and get the difference in that price. So often it's not $3 or $4 that you're dealing with options. Often you'll be getting an extra maybe 30 cents to $1 per bushel. So often those are higher bushel increments that you would use. So you get into 5, 10, maybe $20,000 or $50,000 bushel options that you would use. So these again are the marketing contracts, and just to review, speculators, people who aren't necessarily growing a crop, or farmers would use the futures contract and options. They do require a broker. They require a separate account that would need to draw from. The majority of farmers, or hopefully farmers, are using the forward contract, a hedge to arrive, or a basis contract. And that's really looking at what their crop production is, what their crop expenses are, and trying to get not always the highest of the market, but getting a good margin of price. So if it costs me $2 to grow corn and I'm making 50 cents per bushel, that's where you can start to see the profit. And happy to answer any questions or go back if you have any details you'd like. These are the web resources that I like, and I think I've got some screenshots on here. You hear a lot about the Chicago Board of Trade. They actually merged, and now they're called the CME Group. They have a lot of information on their page. I try to go to their page daily just to see what's going on with prices. They have an agricultural page. A lot of they quote many other commodities, but you can go under the agricultural commodities, the grain commodities. There's the AgWeb, and I'll show you that. That can give you some information about local markets. It's a little bit delayed as far as your quotes go, but it is kind of interesting to look and see what your local markets are quoting, and I have a screenshot of that later. There's lots of other commentary and local elevators that you can work with. So I get text messages from one of our local elevators. They send out texts at 11 and at 1. So I can see what the market's doing and if it's up or down. I also get an email from another elevator that offers, it's from the lower shore and has prices. So many of your elevators locally may have a website or offer information. And there's tons of commentary out there. Every farm journal, trade journal has a market commentary. And of course, lots of popular press and market experts are out there trading grain and working with grain. This is some terminology, again, that you'll hear. Bear markets are people who expect, bear markets expect lower grain. This is a typo. Bull markets are the higher prices. So if you talk about a bear market, which we're in, we expect lower prices. And a bearish market is a market in which prices are declining, which we've definitely seen. The bull market is where we expect higher prices, and bullish is where we see prices increasing. So hopefully we're going to see a turn here in the near future. These are, when you talk about the futures month, and the futures will expire 30 days before that futures month. So when you look at corn, you often will look at the December. That's your harvest month, will be December. And then when you're storing grain, if you have storage, they talk about JFM, and that's January, February, March. So you'll have those price quotes as well if you're storing grain and plan to sell at a later date. For soybeans, the harvest month is November, and that's how it's quoted on CME, and their storage again is JFM. And then wheat, your harvest futures month would be, their harvest is July. So if I log on to CME Group to see what our futures are, and I want to compare it with a local elevator, I say I look at the December price for corn, the November price for soybeans, and the July price for wheat. And then I can ask the elevator what their harvest price is for those three commodities. I'm not sure this, hopefully this shows up large enough on your screen. This is a screenshot from the CME Group. When you go to their agricultural page, you can see corn futures, soybean futures, and wheat futures on here. Those are the three that I generally look at. They're quoting the nearby contracts, so the closest contract you can do is March, because again, the February would have already expired. You can see the OPT tab here are the options. So if you wanted to purchase a put or call or see what they're trading at, you could click on that. You have what the last trade is, whether the price went up or down, what the change was. You can look at a chart. You can see what the opening and what the high and low prices were. And I always like, so I clicked on corn. So we're going to go through a corn example. When I click on corn, I have my March price, but then I can look at December and see what it's trading for, $3.91 and 6. So I can make decisions based on that. And you can see how far out corn can be quoted on. That's what contracts are trading right now. So the December price would be my harvest price that I would look at. When I click on the chart, this is what it pulls up, and there's lots of ability to change the charts, to get more detailed information. You can see where the price was going up and down. You can see the ticks and where the grain traded that day and where it settled that day. And you can see it over time. And a lot of people like to trade with trends and seeing where the price is going using these graphs. And I've got some graphs later in the presentation that will show some average prices received on a larger trend. So this right here, just looking at 3 months, really doesn't give us a lot of information if we were going to make major trading decisions. But it does at least tell us where grain prices have been and kind of where they're going. So they've hit bottom, and they are coming up a little bit. Maybe not fast enough for some of us, but they are trending upward, thankfully. This is the cash grain bid. So what we just saw was the futures. So that's the national price. This is your local cash price. And this is on AgWeb. And I like looking this up every once in a while. You can type in a zip code. Again, it does have a delay, but it will tell you what trades that they're making and what they're pricing corn for today. So you can see here at Purdue Farms in Easton for new crop corn, it's $3.92 with a 0 basis. Soybeans, if you have them stored, what you are getting, and then new crop soybeans and what the basis is. And so they're really saying they're kind of full. The basis is negative. You need to know what a regular basis is for your area. And then you can see what Mount Ayr is quoting, and then you can go on down and see what the other locations are quoting. So again, they talk a lot about new crop and old crop. So old crop is what we have stored. It's what we have in storage that we might be delivering. New crop is what we would be forward contracting for and planning for this year. Wanted to point out a couple marketing tools because they really go hand in hand with grain marketing decisions. One is crop insurance. And it really, crop insurance does allow you to contract with confidence. People get concerned about contracting too much of their grain because they want to make sure that they're going to have a good crop that year. And a lot of the marketing analysts say that if you have good coverage, in reality, you could contract all the way up to your coverage level of that crop. So if you buy crop insurance at 60% or 70%, you could essentially trade up to that amount. Most producers don't. I'd say most producers are only, if they're marketing at all, they're probably doing a quarter to a third of their crop, maybe half, but they don't go much over that. And we've had a couple years here at Delmarva where prices were good. We contracted a lot of grain, and then we weren't able to fill the contracts, and they had to roll over. And so that's a kind of a short-term memory that we have about that. This is a website with our crop insurance. We also have crop budgets that are posted, and these are just estimations, but We drive home the idea that you really need to know that cost of production. How much does it cost you to produce a bushel of grain? And then you can start to make your marketing decisions from that. So again, if it costs you $3.50 or $3.25 to produce a bushel of corn, then you know that you shouldn't contract anything less than that. You either want to break even or lock in a 10 or 20 or 50-cent profit. So you really need to know your break-even price. And this is our website where we have our crop budgets. Just showing, again, the crop insurance. These are our Maryland crop insurance sign-up deadlines, so they're quickly approaching. And then these are our crop budgets for 2016. We've got multiple budgets out there. We've got corn no-till, corn conventional. We have it irrigated. We have it with poultry litter. We have soybeans, wheat, and wheat beans. So that is the cost per acre. And then you can always do calculations on per bushel. These are also downloadable by Excel. So if you want to download it and do some tweaking or change your numbers, which we encourage everyone to do when they make their own personal marketing decisions, you can download those off the website and have a good template to start with at least. So a number of years ago, we started working with the Winning the Game, the Center for Farm Financial Management, and this is an example of one of their pre-harvest corn marketing plans. And what they really, we do a presentation and then we actually play a physical game where we use a marketing plan and we go through a marketing year and make decisions. What their main goal is that you need to set a minimum price, saying that you're not going to sell lower than that, and then helping to set decision dates to make pricing decisions. That often the months where grain prices peak are months where we're busy in the field. Maybe farmers aren't looking at the markets or studying them as much. So setting these decision dates will tell you, whoa, you know, let's check the markets, let's check our production, and let's make a marketing decision. So what they do is they have it incremented with their total or with what they were going to contract. They set a minimum price, they set a date, and then they used a fixed price of, you know, a forward contract and with an option possibly. And they go back and talk about, so why should you look at those decision dates? What times of the year should you look at? And this is an example of prices for corn from 1990 to 2015. What the price was on May 1st and what the price was on October 1st and what the change was. In 19 years, or 73% of the time, you can see that the market declined from May to October. In 7 years, or 27% of the time, the market actually improved. And most people do remember the 2012 year. You can see the market improved by $2.18. So who out there remembers that year? And you'll see it. I have the same chart with soybeans. That year was really it was interesting with the world market. We had a drought a number of places, and so that really is an anomaly when you look at the other years where the price improved. So you can see it's almost on average of those years a 28-cent difference from May to October. And if you multiply that by the number of bushels that you're contracting, it can be significant. This is it graphically, looking at it. So again, that March, April, May, June, in that time frame, that's when we've historically seen prices go up. So don't forget to sell something in those months. And when you write that marketing plan, you know, include some dates where you sit down those months and make some decisions. This is the same chart for soybeans. You can see 17 years, or 65% of the time, the market declined from May 1st to October 1st. and 9 years or 35% of the time the market actually improved. And again, that 2012 year, we had a significant improvement. We also saw that in 07 and 2003. Again, with world markets, some of the South American markets, you can see a difference. But overall, on average, 32 cents is what the difference would be from May to October. And this is those numbers graphically. And again, you can see that April, May, June, July are places where the price really goes up. And then again, you can see it dip during harvest time. That's it for today. That's all that I wanted to share. I know there's a lot out there about grain marketing, but that really is the basics that we cover when we get started.
Thank you for watching our archived presentation of our Wednesday webinar. If you would like to see more archived Wednesday webinars, please visit our YouTube channel, or to find a schedule of upcoming live webinars, visit our website.